Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just interviewed Jayson Cahill. He is a first-lien HELOC specialist with First Savings Bank. Anthony, what was a takeaway or two that you had?
Well, it was interesting that this turned into really using the concept called velocity banking, which I've heard some about it. I know we have some clients that are using that against policy loans. So it's a way to accelerate debt. However, but just to talk through with that of somebody,
Yeah.
I mean, velocity banking is a niche. It's not for everyone, but I will say that I think everyone should know about it. It's always important to know what the options are. Another takeaway is something that we always talk to our clients, like what Nelson Nash had mentioned in his book, Becoming Your Own Banker, is don't focus about rates. Let's focus on volume of interest. Because oftentimes we're like, what's the interest rate here or interest rate on this? But we need to look at is how much interest we're actually paying. That being said, when the tables were reversed, these first lien HELOCs have a higher rate than a 30-year fixed mortgage. So I went back to the rate. And he had alluded to it's not about rate, it's about volume because we're paying down that mortgage quicker. So even though there may be a higher rate, we're paying less in volume, aka interest. What were some takeaways that you had, Cam?
Interesting conversation. I appreciated it and still very intrigued to get into some of the details. The takeaway that I had is that a lot of times clients will come, not a lot, but a few times over the years, clients have come and they're very passionate about, hey, I want to pay my mortgage off, right?
Yeah.
We'll go through pros and cons of that. And I've got several of them that we're kind of walking through kind of a debt reduction schedule now. But previously, just sending money at your mortgage, extra money on a 30-year fix, terrible idea, right? You get very little benefit from that. The next best thing that I've been aware of is really recasting it. And that's the strategy that I'll walk clients through. But again, right, that's a one-way process. You send in money to a bank or your lender and you get your reduced balance, but you don't have access to those funds. This first lien HELOC, I was very intrigued because the two-way process or aspect of it is that, man, you make a payment, you've still got access to those dollars. And so I can appreciate that. And I think it could be a real advantage for a lot of people. So,
one thing I wanted to add is
okay.
in the show notes is there's going to be some links to some videos where he's going to share a case study where we can take a look at some numbers.
Yeah.
So we want to make sure you are aware of that. And also, if you want to learn more about infinite banking and how to create more passive income than your monthly expenses, hop on a discovery call with us. Let's kind of figure out what your goals are and see if infinite banking is for you.
Yeah. Jayson Cahill, he is a first lien HELOC specialist at First Savings Bank. And a first lien HELOC is an option to replace your mortgage and also have access to all your equity, not just the amount of the smaller second mortgage HELOC. So hope you guys enjoy this episode.
Take care.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and I'm excited about today's episode because I think most of you are familiar with the home equity line of credit or HELOC as a way to access the equity in your house. But did you know there's an alternative? And today we've got an expert. We got Jayson Cahill. He is a first lien HELOC specialist at First Savings Bank. Jayson, thanks for joining us today.
Hey, thank you, Anthony. Thank you, Cameron. Thank you both for having me here to share some of this information about what we do in regards to a niche product called the first lien HELOC, how to access that equity and pay down our mortgage a little bit quicker and then retain access to those funds too.
I'm excited. This is a conversation I've had with clients many times over the years. The topic comes up often. And so instead of having Anthony act like an expert, we got a real one here today. So, Jayson, I'm excited, man. I'm going to throw it to you. Tell us a little bit about your background and kind of how you got to this position, and then we'll kind of get in the first lien HELOC.
Yeah, for sure. Thanks. So traditionally I've been in lending for the last 20 years, plus actually now doing conventional VA, FHA, all the normal mortgage loan officer financing, doing the right thing, giving clients low rates when they're
Mhm.
low and refinancing cash out, helping them with their purchases. So had a very successful career doing that. And then almost about 2 years ago, came upon this opportunity just out of chance. Someone I knew the hiring manager, introduced us, and I had heard about the concept, similar to like a lot of people hear about infinite banking, you hear about velocity banking. So it was really like a change to my career of looking at it and coming in saying, this seems too good to be true. Like, why aren't more people doing this? So I really had to take time to understand it, look at spreadsheets, and really dive in before I made that career decision to be solely focused on the first lien HELOC. So that was my journey to get here. And then the team I work with have been doing the first lien HELOC for about the last 10, 15 years. And they had a really good platform that they brought to First Savings Bank about 4.5 years ago now. So,
Great, man. You've mentioned kind of the first lien HELOC a few times now. For the listeners, if you could maybe share with us what a first lien HELOC is, who's it for, what does it do, kind of the
yeah.
high level stuff.
So it's certainly a niche product, not for everybody. It has its advantages of using our cash flow to pay down the balance. So what we're going to do with a first lien HELOC is replace an existing mortgage. So we're going to have a balance, let's say 100,000, and then we're going to determine a limit based upon the appraised value. So we may say your limit is 150,000. And the whole concept is it ties in with the velocity banking keys. We're
Mhm.
going to set up a checking account that we direct our payroll into, our household funds to deposit, and then that checking account's a pass through. It's going to move all the funds over to the HELOC to decrease that balance automatically. And then vice versa for expenses, we'll be able to route those expenses out as they come through.
Great. Well, who's this a good fit for, right? If somebody's out there listening, they have no idea kind of what this is. We're going to dive into it a little bit more, but who should be listening? Who should be paying attention here to this episode?
Yeah, so a lot of our typical clients can be anywhere from a W-2 employment, self-employment, and really we have strong cash flow. So in an example, we may have 5,000 come in and 2,000 go out as expenses. And the other key part to that is what's your loan amount. On 100,000, that ratio would work really well to where we pay that 100,000 off in about 3.5 years. If that loan amount was 400,000, we wouldn't have the same success. So it's really when we're looking and discussing like who's it best for, we're trying to uncover those three factors. What's the income, what's the expenses, and what's your loan amount. So each of those will determine if it's a right fit.
So, in essence, what I'm hearing is somebody, you use the example, earning five and their expenses are two, right? So those ratios might be a little bit unusual, I would think. I mean, to have twice as much income as their expenses, um, but what they're saying is that extra 3 grand, right? It has to go somewhere. And what with this strategy is we're leaving it against the HELOC, which is lowering the mortgage, right? So we're eventually using that our extra cash flow to pay down the mortgage.
Correct. So as that 5,000 comes in, today at midnight it sweeps over, drops the balance from 100 to 95,000 automatically. Then when we route out our expenses for the month, that 2,000 as an example, it adds back. So now we owe 97,000. And now we come back and calculate the interest. This is a simple interest calculation
Mhm.
based upon the daily average balance. So if we held that balance at 95 for 25 days, another 5 it was at that 97. Now we're calculating interest on 95,000 versus that original 100,000. And then that's automatically added back to the loan. So it might be, let's say that was $500. Now you owe 97.5 at the end of the month. So with our positive cash flow, we reduce the principal by $2,500. But the other advantageous piece is we retain access to that liquidity as we keep suppressing the balance down. So
Okay.
yeah, that cash flow is that success. If we spend 4,500 out of our 5,000, and then we add our interest, we're gonna break even.
So the HELOCs, I think one concern of a HELOC is the adjustable rate, or maybe tell me, is there some fixed rates, or what are the rate options on a first lien HELOC?
Yeah, so it is going to be a variable rate product based upon an index and a margin. So
Hmm.
each bank will determine what index they tie it to and what margin they set it on. So that is obviously one of the things that we look at as part of that success factor. We first come back to the income and the expense ratio. If those are not in the right place, like if we spend 5, or if we spend 5 out of our 5 that we bring in, the rate's not going to matter because we're not going to have the right cash flow. But with that 5 to 2, and if we could pay off in about 3.5 years, we can absorb today's current interest rates or even yesterday's lower interest rates because of that strong cash flow.
Okay. Okay. So you're saying is because oftentimes, and we talk about this a lot, and so does Nelson Nash in Becoming Your Own Banker, is that it's not about rates, it's about the volume, right? The amount of interest, and we often are chasing these rates,
Yep.
which, to be honest, as I say that, that's kind of what I was just doing. I'm thinking, right, my mortgage. Well, now it might be a little different if you're getting a new mortgage, but a lot of people, and I would imagine our listeners are going to fit in that category, took advantage of these low rates,
Mm-hmm.
and they probably have a 5 and under, and prime, or I would think HELOCs are around 8 to 9. Is that
Exactly.
fair?
We're gonna
I know that.
we're gonna
Okay. So what I'm thinking, wait a minute, why would I pay 9 when I'm only paying 5? But
that's our
what you're
typical
saying is,
starting point of a conversation. Exactly.
yeah,
Yep. Or
okay,
even 2.875. That's on average. Anybody from 2020 to 22 almost might be in the high twos, low threes. So why do we trade that debt for a variable at a higher? It still has to come back to those first two: income, expense versus loan amount, to then can we outperform that fixed rate, which our clients that we're placing in that, yes, with those right factors, we're outperforming their existing fixed rate because of that volume of interest. If we're paying it off in 5 years with 100,000 of interest versus, let's say, the current amortization loan had 150, our total volume is less, our total years are less, driven on cash flow.
okay. So what I'm hearing, what we're in essence doing is really we're just plopping down more on the principal, right? What would be in this example that we're using, what would be the difference if they kept their 30-year at whatever, say whatever the rate is, it doesn't matter, and they just took that extra 3 grand a month and applied it to principal?
That's often a very good scenario that we get. Like,
Yeah,
hey, I've been on my loan for 4 years. Why don't I just add extra 3,000? Well,
yeah.
you've been on your loan for 4 years. How many times have you been in the position to do that? Well, not very many. We haven't done that automatically.
Hmm.
That would be a good scenario to reduce the balance, reduce the years. So that is definitely a good way to go about reducing your mortgage. the one thing that the first lien HELOC counters to that is, as you put all that money in as additional, you retain access to that liquidity. So it's not a one-way street like a traditional mortgage. Every time I put that extra $3,000 to the mortgage on that traditional mortgage, it's now locked to where I can't get that back unless I refinance or sell the property.
Okay, now
Mm-hmm.
that's a big advantage that you hit on was the liquidity, because a lot of
Yes.
times we've talked about, a lot of times our clients are putting a little bit more towards principal. You know, one thing we always talk about, where did that lower your payment? Well, no, because they're not going to recast your mortgage because you paid an extra $100,
Right.
right? But then also, do you have access to it, right? And if you have a traditional mortgage, you can't. You're going to have to go back to the bank and ask for permission. So I can see some advantages there. I could also see some. I mean, we talked about infinite banking, of the discipline that it takes, that we can still the peas. Uh, I think with this velocity, with this concept, there's a risk of where we're stealing the whole store, where it could be very tempting to, well, hey, I have this extra money. Why don't I go on this trip? Or what sort of guidelines or are there bumpers, you know, or is this for only people who have some discipline?
Yeah, obviously, certainly, you're going to have some discipline, because you may have that $100,000 balance and then your line limit is 200.
Mm-hmm.
So yes, we coach and teach our clients, hey, that 100,000 is available, but that doesn't mean we go out and buy a brand new, $100,000 car to drive
Mm-hmm.
around with, and now we messed up our discipline factors and our timeline. So definitely being in control of a budget and having awareness of what's coming in and out is going to lead towards those factors. Now, if you pull out that $100,000, buy a car that goes on to a platform that creates cash flow, and that cash flow runs back through and we're decreasing the balance, that's part of that access to liquidity.
So what is the plan? So let's say with the strategy that we do pay our mortgage off in a few years, then then what's the next step, like, or the next strategy?
Yeah, so typically a lot of our clients have multiple goals. So usually it's coming with the desire, how do I pay it off quicker? And then
Mm-hmm.
that's one bucket. Another bucket is, I don't really want to pay it off. I want to go from 100,000 to 50,000 as quick as possible. Then draw that 50,000 back out, layer it into another investment opportunity, create cash flow, and now go from 100 back to 50 even faster the next time and repeat that process. So the first lien kind of becomes the foundation, and then we can layer additional strategies on top of that. And if you want to only be at a zero balance, well, that line of credit remains available to you for 10 years. So some of our clients are sitting at a zero balance, but they have access to that line of credit if they need it still.
You mentioned Turo. What are some other ways that clients are using kind of that first lien?
Real estate, certainly. Decreasing the balance, drawing out equity, purchase that next property, and then running that cash flow back through. Infinite banking as well. We can tie in that as well. If we're decreasing our balance, we can draw back out, fund our cash valued policy, and kind of layer those structures together. So we have various opportunities that our clients come to us with. Here's what I'm thinking I want to do. How can we structure this? And it's individualized, really.
Jayson, with qualifying for this, is it similar to a traditional mortgage, easier or harder?
So similar concepts as far as credit, appraisal, debt to income ratio. We're going to have certain factors for each of those. And then, yes, we're going to stress test the line of credit to where it is going to be a little bit harder to qualify than a traditional loan because of the concept. We really want to make sure that clients that we're placing into the first lien HELOC have those right income to expense ratios against the loan amount so they're going to be successful.
So, what are so this sounds like an interesting concept. It sounds like it also needs some coaching, or right, to make sure people are not only qualify financially for this, but I mean, I think there's qualifying mentally, right?
Yeah.
Are there some tools or guidance to determine that?
Yeah, absolutely. So again, I work for First Savings Bank. This is the only product that we do on our team is just the first lien HELOC. But
Mhm.
we also work in coordination with firstlienheloc.com. It's a resource platform, educational site that provides a calculator, just the background of it. And so that's a really good starting point that a lot of clients come to us from, along with then other sources out there as well that will help guide and coach too. And then ultimately, the first lien stays with us. So then um, we're here even after clients close. It's a lot different. What I enjoy about this position, it's a lot different than when I was a loan officer saying, "Hey, I'll call you if rates go down."
Mm.
Right? Like now it's, "Hey, Jason, we're thinking about buying a car. We've got some funds on hand, but we also have the equity in our first lien. How should we work this out?" And so we'll walk through our calculations and say, "Hey, this is going to be better to fund it out of the line of credit. You'll pay it off in 14 months instead of 60 months if you financed it."
Okay, so what I'm hearing is there's some ongoing coaching or consulting per se, which is great. Is there a fee for that, or is there additional fees to getting the mortgage? Or I mean, you obviously need to be compensated for your time. This is a lot more effort than just getting a mortgage. I mean, there's more hand holding.
There is. So we have our initial conversations, but that's just part of our process. Um, and no, yeah, there's no additional. When clients call me for questions, it's out of just wanting to help them out. So
Jason, you mentioned the resources. And you mentioned the calculator. If someone goes to firstlienheloc.com and checks out the calculator. What is that going to show them? How much they qualify for? What the rates are? What are they gonna get from that?
they're gonna fill out like their current mortgage balance, their income, typical expenses that they have, some other key factors, and then it'll give them a live version of what their timeline could be to pay off, and then compare it against their current mortgage as well too. So it'll be a good starting point to see, are we in the right balance of income versus expenses? And
Great.
then from there, it gives the opportunity to then book an appointment with a specialist such as myself or someone else on the team too.
Nice. A lot of times we'll get clients that have equity and they're looking at like a cash out refi,
hmm
right? How would you compare kind of this to that option?
So
Question.
great
Yeah.
question. Yeah, because the both are going to give availability based upon the equity. A
Mhm.
traditional mortgage cash out is typically going to be maybe 70 to 80% of the appraised value. The first lien, we can typically go up to 90% of the appraised value as the max limit with
Mhm.
no mortgage insurance. So it's really going to look at what's the need of those funds, and then back to our core concepts. As we pull those funds out, what's our income versus expense going to be to drive that balance back down?
Jason, where I know we're talking traditionally about someone's primary home. Is this available for investment homes or second homes?
Currently, we're only doing it on the primary residence. I'm sure at some point we'll probably roll out a second home and investment property, but currently we're driving it on the primary. And then some of our clients will use that primary and decrease the balance. As they're decreasing that balance, they'll draw out and maybe chunk down another debt that they have, such as another rental property. So we kind of balance load it.
Jayson, doing research, I came across a phrase. It was the sweep strategy.
Correct.
Yeah. Can you tell me a little bit about that?
Yeah. So a first lien HELOC is a product that could stand alone, where you just have that set up and you have access to it. The real key part to it that simplifies it is the sweep. So we set up a checking account here at First Savings Bank to have our household deposits come into. And then at midnight, it's the automation. It sweeps over from the checking to the HELOC automatically. So we're taking it out of your hands to manually make those transfers. And so it goes both directional for income in and then expenses out. It's always pushing and pulling back to the HELOC.
Okay.
So to maximize your velocity banking concepts, you want to find a first lien HELOC with a sweep feature with that checking account set up.
And is what's provided through First Savings Bank, like that specific checking account, or is that? I mean, I've got accounts with many different banks.
Correct. So after we close, we're onboarding the first lien HELOC and opening up a checking account that's attached to the first lien. So it's attached with that sweep feature. So, and the difference that I let clients know is this checking account is basically always going to be at zero. So it's a little bit of a mental shift because,
Yeah.
going back to my college days when I had $1.35, that would set off alarms. But like now, like we're looking at wanting our account to be at zero because that means we pulled all the funds over to the HELOC to drop the balance and reduce our daily average balance.
And then I assume that there's mobile, there's an app, there's all that, tech stuff that comes along with that. Is that right?
Correct. It's like
Okay.
every other traditional checking account. You have your bill pay, mobile banking, debit card, credit card,
Okay.
or sorry, not a credit card, but your checkbook. And you can see both accounts next to each other when you log on. So now we're looking towards, instead of seeing a checking account balance, what our clients are looking for is what's their HELOC balance in comparison to the available line amount. So part of that becoming your own bank system in a way.
Okay.
Now, you know what? There's been a lot. I first got exposed to velocity banking a couple of years ago, and I think in part when people are searching infinite banking, a lot of times people will confuse the terminology. So
Yeah.
it's interesting sometimes when you do a Google, when you search on YouTube, you will see velocity banking but it does seem like it does overlay and that it can work together. And I know that you've been looking at infinite banking for yourself, and I'd be curious. I mean, and also you being in the finance business, you're probably a little more skeptical of some of these concepts. So I was curious what your initial thought was of infinite banking and if that had changed and how.
Yeah. Prior to coming here, the concept of infinite banking or velocity banking were foreign to me. It was something I've heard of and seemed like
Hmm.
maybe a good idea. And even myself being here doing this every day, I learned about infinite banking,
Hmm.
and it was kind of one of those. I didn't do anything yet. I didn't do anything about it because I kept putting everything off, and then finally we're like, all right, we got to get this set up. So yeah,
Hmm.
recently my wife and I set up our cash value policies, and part of our strategies are going to be using our line of credit when needed to draw and fund our policies and layer that into part of some of our investment strategies. One of our recent investment strategies was we found someone. We travel a lot. We go to Colorado. We ski a lot, and we've always wanted to have a car when we go out there.
Mm-hmm.
So we funded our cash valued policy, took a loan against it, purchased a vehicle, placed it on Turo, and someone's going to manage it for us. So now we get multiple different advantages. We get potential cash flow. We have a car that's available there. And oh, by the way, there's also tax advantages because of the type of car that we got. So we're taking and layering our strategies together for them to blend to and work for us.
Well, I also like, how you solve that problem. Hey, we travel out this area. We'd like to have a car, right? And so how can we have a car that actually generates some money? Or even if it was cash flow neutral,
Yeah.
at least you have a car that you don't have to call Turo or rent a car.
Yep.
But it sounds like maybe we're even making some profits. But that I like that mindset, and similar to Robert Kiyosaki, where he talks about if we want like a liability, which we would call a car, well, let's have an asset and pay for it. And what you've done is created a business to pay for it. So I think it's I think that's great.
Yeah, and then we also incorporate, instead of going out and getting a car loan, we used it from our own banking system as well too. And then so we went out, purchased it in cash. Now with that, with the money that'll be coming back in, we'll repay ourselves back into our policy.
Jayson, right, what are the downsides? Are there any downsides to doing this? What should people be careful of?
Well, certainly it comes back to, do we have that right income versus expense? Like in our that example that we gave 5,000 in, 2,000 out. That's going to work really well. If income is 5 and expenses are 4,500 and we're breaking even, now we got to dive in, like what's making up those expenses? Are there things that we could pay off to lower those expenses, or are we just stuck there and maybe this isn't the right path at this moment? So that's definitely the downfall to consider. Do our expenses start to creep up towards our income?
Great. Awesome. Jayson, again, where can somebody find some more information about this?
Definitely the team at first-lien-HELOC.com does a great job of providing all of these details and resources and online calculators and tools, along with an ability to schedule appointments with myself and others. So first-lien-HELOC.com would be the starting point that I would recommend.
Great. Awesome, man. Is outside of that, do you want to share an email, and if anybody wants to get a hold of you specifically, or we can add that in the show notes later?
Yeah, let's add that in show notes. So I don't have to spell it all out, but it's pretty simple, but sometimes it might be hard audio to. But yeah, we'll give you an email and a phone number to connect.
Great, man. We'll make sure we get first-lien-HELOC.com, and we'll get your contact information in there. Jayson, man, really appreciate you coming on today, sharing your insight, and telling us all about first-lien HELOCs.
Yeah, thank you both. Thanks, Cameron. Thanks, Anthony. Great chatting, and always great hearing your podcast.
Well, thanks, and go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.